Hello, everyone, and welcome to a market update for 2 February 2024. Can't believe January's already gone flying by. You blink and a month is gone. I do trust that everyone had a wonderful break over the Christmas, New Year, and January period. I certainly did. Did a little bit of traveling, lots of resting, and lots of eating and drinking. It was great. So back into the grind now, well and truly. And there's been a lot going on, both in the macro environment, the stock market, and globally. We've got conflicts going on around the world, some things seemingly heating up. There was an attack in somewhere in the Middle East. I think a base in Saudi Arabia had some drone attack. They blamed that on Iran. Quite interesting. Obviously, the long-standing conflict going on in Ukraine and what's going on with Israel and Palestine. Among probably many other conflicts that are currently raging. We've got China in horrendous shape at the moment, and Evergrande, who is a big property developer there, has just declared bankruptcy, or the Chinese government's probably decided to just go ahead and shoot him in the head and get it over with because they needed to deal with that situation and have needed to deal with that situation for a little while. Shooting him in the head is probably not a great appropriate metaphor for the Chinese communist dictatorship regime. But in any case, we press on. The top three things today, I'm going to go into all of that stuff and more as I give you a bit of an update on where we're at so far, what we're looking at coming down the pike, and how I think the middle part of this year is going to start to shape up. So number one is GDP. We had GDP numbers come out of the U.S. this week. That was quite interesting. Going to go into that. Talk about interest rates. There's been a lot of interesting movement going on in the bond market, beginning to really price in rate cuts, which really means they're pricing in recession. And then I'm going to talk about the quads. As I probably have mentioned in previous updates, I'm getting monthly quad data out of Hedgeye, which is quite interesting. I'm going to show you a chart on that. Unfortunately, not for Australia. We don't have enough data really that comes out of Australia on a regular enough basis to have monthly quads. But nevertheless, we do have a quad outlook for Australia as well. I'm going to start with GDP. So I've got a chart here on your screen of the U.S. fiscal deficit in 2023, and then the deficits going all the way back to 2000. One of the things that ought to stand out like the proverbial on this chart is that the U.S. government has been running a deficit since 2001. And in some years, naturally 2020 and 2021 being those COVID years, they ran quite substantial deficits to help prop the economy back up and all the spending that they did. Was it necessary? Probably not to the degree that they did it. There was a lot of graft and a lot of other stuff that went on that's now coming to the fore. Businesses and people that probably did not need money or support took it, and we're now paying the price for that, which was higher inflation numbers, Fed having to raise interest rates, inflation sloshing around the planet, affecting other economies, etc. But the main thing really to note here is that the deficits have been really accelerating in the last few years, and the projections are for continued acceleration of government deficits, and as you can see, getting worse and worse and worse as the next 10 years unfold. So 2023 wasn't, horrendous in terms of deficit, still 1.6 trillion, but moving into or 1.7 trillion as it says here at the title. But I mean, if you just look at this chart, there's deficits as far as the eye can see. What does this have to do with GDP? Well, first of all these deficits, when the government runs a deficit, for those of you who haven't ever studied economics or aren't sure on how this works, when they run a deficit, they are spending money they do not have today. They have effectively printed it. They've created it out of thin air. They've printed it, and they've spent it. And we all know that government typically does not spend money wisely. And as a result, we get things like inflation, we get misallocation of capital, we get capital going to the wrong parts of the economy, all these sorts of things. And what they're doing here is they are borrowing from the future. So anytime a government runs a deficit, you should be outraged. And the reason for that is because they are stealing from your future self. They are borrowing, but let's just call it what it is, stealing. They're stealing from your children, And if you're a bit of an older Australian or one of my older clients, then they're stealing from your grandchildren. They're stealing from future generations. It's wrong. It should not be allowed to happen. And unfortunately, it's the world we're currently living in. It's the way the system is set up. It is a debt-based monetary system. So what does this have to do with GDP? Well, we had a GDP number come out of the U.S. Last week, and the GDP came in at 3.11%. Now that sounds great. GDP went up, 3% GDP sounds fantastic. However, there was a number that they used, and I've talked about this before many, many, many moons ago and episodes ago. I talked about the GDP deflator. Now you can look up the GDP deflator and watch a little video on it or look at a definition of it. But basically what they do is they try to adjust the GDP for inflation. So they take out inflation, and this deflator number is what they put in there to adjust what they say is adjusting for inflation. And the problem is when you don't have the right inflation number in the GDP deflator, it can overstate GDP. So I think the GDP deflator number they used for this last iteration was like 1.6 or something like that. So that adjusts the GDP down. What they should have used was probably a number around the 5 or 6 or 7%, because real inflation is actually much higher than any of the measures of inflation that government or departments of government use to calculate inflation. Inflation's much higher. We know that as consumers. I see it. Healthcare costs are up. Fuel costs are up. Going to the grocery shopping is up. All the things we need, utility prices up. All the things we need seem to be going up. Rent up. So it's really a con game that they are trying to get us to buy into. And I'm not going to let you be fooled by this stuff. And by the way, they do this in Australia too. It's just not as obvious. And so I want you to be educated and informed as to how these things work. In any case, my point in telling you all of this is to say that the economy is worse than what they are, sort of the gloss that they're putting out there around this. And that is becoming increasingly obvious in what bond markets are telling us. Now, I don't have a chart of bonds and the bond market up here. But for those of you who watch and log into your interactive broker accounts, you would have noticed that a lot of the bond investments are now starting to really pick up because they're long-dated bonds. They're designed for a Quad 4 environment. That's why they're owned. And just looking in my notebook, I can go back to early November in this particular notebook, where the U.S. 30-year Treasury was sitting at around 4.8%. The 10-year Treasury was sitting at 4.64%, and the 2-year rate was sitting at 4.94%. That's called yield curve inversion. The short end of the curve is higher than the long end of the curve, and that's because the Fed really influences the short end of the curve. So interest rates being higher, that influences the short end of the curve, and the bond market is in control of the long end of the curve. That's kind of all you need to know, I suppose, about that. Fast forward to the close yesterday, so the 1st of Feb in the U.S. The 30-year, remember, the 30-year was at 481 in the early part of November 2023. Today or yesterday, the 30-year sitting at 4.11%, so it's dropped about 70 basis points. It's a pretty significant drop for a 30-year Treasury. The 10-year, which was at 464, is now sitting at 384. Again, about 60 basis point drop. And the 2-year was at 494, is now sitting at 4.2. So what we're beginning is to see is some compression in the yield curve, and what will eventually happen is short-term rates will fall drastically when the Fed begins to cut interest rates. The long end of the curve will also drop, but you will see a normalization of the yield curve. In other words, long-term money should be paying out more than short-term money. If you think about it, if you're taking a 30-year mortgage, or you're giving somebody money for 30 years, you should be compensated at a higher rate than if you gave them the money for 2 years. But the curve is inverted right now, which means that people are being paid more to give the government money in the short term than in the long term. What is that a sign of? It's a sign that the bond market knows that we are entering a recessionary period. And what we're seeing here on these GDP numbers forecast is a slow burn down in terms of GDP. So that's just a little bit of a look forward in terms of GDP numbers in the U.S. Interestingly, and I'll just touch on this very briefly, inflation seemingly is going to hold steady here. This is sort of these core inflation numbers or whatever, seemingly going to hold steady around the 3% range. Now remember, the RBA, the Federal Reserve, all central banks seem to have a target range for inflation. Now, the U.S. Fed has a target range of 2 to 3%, and it's similar here in Australia. So, and actually, interestingly enough, I can just quickly tell you, Aussie rates have also come down. Back in November, the 15-year rate, which is one of the longest-term government bond rates, was at 5.01, and now it's sitting at 4.26, so or thereabouts, 4.26. I haven't checked it today recently, but around 4.3. That's a pretty big drop, 70 basis points again, and the 2-year was at 4.38 and is now sitting around 3.68, so about an 80 basis point or thereabouts drop there. So quite a significant drop in interest rates too in Australia. Because why? Well, again, the bond market here in Australia probably knows that we are heading towards a potential recession. Now, Australia, not so much, because our economic quad outlook is a little bit better. But I wanted to show you a couple of things as well. If I could just go back to GDP. One of the reasons the GDP number was so good, one of the reasons why those deficit figures are so large, is because the government is spending a lot of money. And we can see here that the government participation, this is in the U.S. by the way, the government participation accounting for GDP is about 17%, but in 2023 it's accounted for about 30%. So normally is around that 17% of GDP, but it accounted for about 30% of GDP in the U.S. in 2023. The government is spending money, a lot of money, trying to prop up the U.S. economy. That's effectively, I think, the way you could view that. It's not a good sign and not a good thing. We are in an election year, and very soon, I think the conversation will turn to the crazy amount of spending that the government is doing and reining that in. I mean, it's almost like there are just people in Congress right now who just think you can just spend into oblivion. And it probably goes to some of those, modern monetary theory arguments. Janet Yellen is one of these MMT nut jobs, thinks you can just spend your way to prosperity. No, you cannot do that. You cannot create money out of thin air, give it to people, spend it, and not expect or expect there to not be inflation. It's just astounding. I mean, it's the idiots are in charge at the moment. It's just crazy. So that's a little bit of a discussion about GDP and interest rates. And I wanted just to show you, hopefully I've got it here on a chart. Yes, here we go. Monthly quads. So let's move to the quad conversation. This is a projection for the U.S. for the months, for the full year, actually, of 2024 and what that looks like. So right now, in January, we're in a quad 4 environment. And what's going on with the interest rate complex is absolutely telling us that. I'm not going to go into the economic data and everything and the updates that I had, quarterly updates from Hedgeye, but you can, or I should say, and you can believe me or not when I tell you this, the economic data continues to deteriorate. As I've been saying all year, the consumer continues to be under a lot of pressure. That's as a result of interest rates being high and elevated, lots of consumer credit out there at high interest rates, and now we're starting to see delinquencies increasing over a 30-day and 60-day period, and some of these effects moving their way through the economy. And I'm going to comment in a second on, well, why then is the stock market doing so well? Well, the stock market is not a reflection of the economy, and I'll get to that in a moment. Anyway, let's get back to the quad. So we've got 2 quad 4 months coming up back to back. It'll be interesting to see, and well, now we're in February actually, so it'll be interesting to see how things unfold this month with the stock market and the economic data. We then go into a period which is going to be really interesting in March and then April, where we've had a spike in the price of oil because of what's been going on in the Middle East and the Red Sea, this attack on U.S. Soldiers in Saudi Arabia with Iran drones. Whether or not there'll be an escalation there, or not, we'll have to see. The oil complex seems to be discounting that slightly. If I were to just quickly go to CNBC and look at the price of oil, it seems to have come back a little bit from where it spiked to recently. And I'm just going to quickly look at WTI. I think it got up to about $78, $79 a barrel. Yeah, 78.01 late January. So yeah, it's come back a few bucks a barrel, but it's still holding steady there. That is going to impact inflation in a couple of months, and that is what could be influencing this Quad 3 outlook. So Quad 3 is stagflation. It's where inflation is rising, but growth is slowing or declining. And the 70s are the best example of a stagflationary environment. Very bad for the average person on the street. It's because the cost of things are going up whilst wages and other things and growth are declining. But even if you just call that a Quad 4, we basically have 4 months of the poor quad environment coming up. Then, as you can see in the U.S., we'll start to get some better comps. We'll start to get the interest rate complex should be discounting recession, and we'll probably start to get the Fed thawing on inflation and possibly cutting. And I believe I've got a table here. Where is it? I thought I had a table of the. Here we go. This is a chart of the upcoming meetings for central banks around the world. Not all of them, but there's a number of them here. Australia is on this table. The U.S. is there. And what this chart is talking about is what are the chances of a rate cut? What is the market pricing in terms of rate cut? So basically, if it's 0.2, it's 20%, 0.9, 90%, etc. So Australia, very low. Anything below 50% probably means that there's no chance that there's actually going to be a rate cut. And I don't think there's going to be a rate cut at the February meeting, which will be next Tuesday. Unlikely we're going to see one in March unless something really bad happens here. But again, I think, and I'll come back to the Australia quad outlook, I don't necessarily think Australia is going to be in too bad of a shape. However, by the time we get to later this year in Australia, if I can just draw your attention to this line here, the chance of a rate cut goes up pretty high in both in May and then in June. So, and then by August, the market right now is pricing in that we're going to see rate cuts. I think that's going to be broadly dependent on the inflation numbers continuing to come down. So if those continue to come down in Australia, we'll probably see a rate cut. U.S. is interesting because prior to this last Fed meeting, there was a very interesting thing going on in interest rate markets. You've probably heard me talk about this before, but Wall Street really tries to pressure the Fed to cut rates because Wall Street's cocaine is low interest rates. They thrive on low interest rates. That's when all the merger and acquisition and private equity takeovers and all of this stuff goes on. And they just leverage the shit out of everything. I mean, if you can borrow at 1% or 2% from anybody, the Fed or whatever, you're going to do that and lever it up, which is exactly what they do. So they abhor an environment like the one we're in right now where real rates are 6-7% for mortgages and so forth. Cash rates at 4.35 or whatever it's at. And money's expensive by historical standards. So they are begging for interest rate cuts. And just prior to this last Fed meeting, the market was trying to or pricing in like a 70% chance of a rate cut. And sort of every week that went by, that percent chance dropped massively until it was, quite low and almost 10% or something like that, or 20% by the time we actually had the Fed meeting. And then the Fed meeting occurred, and Powell comes out and kind of says, I'm paraphrasing here, but he's like, well, we're not ready to cut rates just yet. So that is why we saw a couple of those bad days on the stock market, because high rates don't equal higher highs in stocks. And in fact, when they do actually start cutting interest rates, the stock market's also going to have a real problem. And I'll come to that in just a moment. In any case, this is a good little chart about what's going to be happening with interest rates over the coming months. And just a reminder, I think it is July and October where there's not an RBA meeting. So we have February, March, then April is not a meeting. Then we have May, June, July, no meeting, and then August, and I think September, and then October, no meeting, and probably December, no meeting as well. So anyway, that's a little bit of an outlook on interest rates. We're just going to have to wait and see. Now, quad outlook for Australia. So actually you get a little bit more than just Australia here, but just draw your attention to where Australia's at. Currently in this quarter projecting to be a quad 4 environment for Australia. We've had a number of good pieces of data coming out with Australia, so it looks quite possibly like we may end up getting revised. Again, we don't have the monthly quad outlook for Australia, but we are going to be bouncing into a sort of more quad 1 scenario by the second quarter of this year, which will be from April to June, and then possibly back into a quad 4 environment. Now, this is primarily based on the levels of GDP that you can see over here and whether they're up or down. So there's not a lot in this whereby there's a big difference between this quad 4 number to this quad 2 number. It's 7 basis points of GDP, which could easily not happen. Or if you look at, if it does happen, this quarter 2 to quarter 3, where we go from 1.15 GDP back to 1.08, we could easily not go back to 1.08. It could be 1.13 or something like that, which is more or less a sort of quad 1 environment. That's a bit off into the future. We are going to need to see rate cuts. We are going to need to see inflation continuing to moderate in Australia, and then I think broadly we'll be back in that scenario. Looking out into the far distant future, though, the GDP numbers for later this year in the fourth quarter look quite good. So I think by the time we get to the middle to back half of 2024, the Australian economy is really going to be doing well. Hopefully we'll see some RBA rate cuts in there, stimulating further economic activity and growth in housing and that sort of thing, and just broadly better economic conditions. But right now, it's caution is the main game, and still being defensive in terms of our setup for markets. Now, I'm going to take just a couple more minutes and talk about the stock market briefly. The interesting thing that's going on right now in the stock market is there's a lot of fund flow, or flow of funds is the better way to put that are going into the Mag 7, those top stocks that Amazon, Google, Facebook, Tesla, Nvidia, Microsoft, I'm missing one, Netflix. And those are, on any given day, a combination of 1 or 2 or 3 of those stocks, Apple I think I mentioned too, is accounting for somewhere between 30 and 50% of the volume and the movement of the index. So, and I think I said this last year as well, or in one of my last updates. So if you look at, say, the S&P 500, it's being heavily driven by a very small number of stocks. Most of the other stocks in that index are actually not doing well at all. And in fact, we're starting to see, we're in an earnings cycle right now, and we're getting earnings reports from a lot of companies that are not good. Now, there are some, like just last night, we had Amazon report great numbers, and we had I think Google report some pretty decent numbers. Meta reports some pretty decent numbers. So overnight trading, those stocks have really popped. Whether we can see that continue, I don't know. We will see. And the other index, because it's a larger index to really look at, is the Russell 2000. So that's 2,000 stocks. That index is down something like 25% or 23% since its peak back in 2021. It's a better measure of the stock market and the health of the stock market. And so the point is that it's a tale of sort of two cities, where we have the S&P 500 index, and even the Dow index for that matter, is being heavily influenced by a very small number of stocks driving those indices to new highs. And what I'm going to suggest to you is that this could be, this period of time right here that we're in February could be that moment where things really roll over, and it's acknowledged that when they do start having to talk about interest rate cuts, the bond market's pricing in recession. When that starts to happen, it's not going to be good for the stock market. So there'll be a repricing of assets once that realization comes to the fore. I think that's about it, really. I don't know that there's anything else that needs to be said. That is a lot in terms of an update. So for this year, I think there's certainly going to be opportunities to redeploy cash into growth assets once we get past, I would say, this first quarter, see how that goes in relation to earnings, interest rate, what's going on in the interest rate complex, and whether or not some of these other global conflicts fire up into anything else. I would imagine if there is any further escalation in the Middle East, then we'll see oil spike. That will be very bad. I don't know if there's a very bad. Bad is bad. That'll be bad for inflation figures in the middle part of the year, which could cause something like the Fed or the RBA to hold rates at a higher level for a little bit longer because, of course, their boogeyman is inflation. That is a lot. That is enough for today. Have a fantastic weekend, and I'm back into it full time here and in the office, happy to take calls, do anything that needs to be done. There's so much going on. It's unbelievable. So, again, have a happy and safe weekend, and I will come back to you next week with a further update. Cheers, everyone.